Hello, this is Alexander Green, Chief Investment Strategist with the Oxford Club. And today I want to talk to you a bit about the state of the market. So many people have been surprised by the strength of the rally and how far stocks have come. And I think that they've fallen prey to what historians call presentism. Presentism is the idea that you judge the past by the standards of today. And so many people are looking at all this negative news, the economic contraction, the spike in unemployment, the states that have had trouble reopening or haven't reopened at all. And they're so dwelling on the present, they're not realizing that the market is a forward-looking thing. And the same thing happens in history. This is why historians mentioned it. Some people look back and they imagine themselves as being more virtuous than, say, George Washington, because Washington owned slaves, and you've never owned slaves, so that makes you a better person. But that's called looking through the prism of presentism, and that can hurt when you're looking back, and it can hurt when you're looking forward. And if you want an idea of how strong this stock market rally is, the two oldest sayings in the market are "Don't fight the Fed" and "Don't fight the tape." Okay, so what do those mean? "Don't fight the tape" refers to the old days when there was a ticker tape, and if the ticker tape showed that stocks were going up, well, you didn't want to be out of the market or short the market, because that meant you were going to be stampeded by the stocks going up in price. You don't fight the tape because there's a general trend in the market at all times. We're either in a bull market or a bear market. We went through a ferocious bear market that bottomed on March 23rd, and since then we've been in a new bull market. No one knows how long that market will last, but we do know that we're in a sustained uptrend because stocks have taken a very significant bounce, over 30% off the bottom. So you don't want to fight the tape. How about not fighting the Fed? Fighting the Fed means if the Fed is making credit readily available and lowering interest rates, that's a positive thing for stocks. Why is it a good thing? Because obviously if interest rates are lower, it's cheaper for businesses to borrow, it's cheaper for consumers to borrow, it's cheaper for governments to borrow. That's all good for the stock market. So when you fight the Fed, you're fighting the easing policy of the Federal Reserve, and never has the Fed been more in an easing mode than it is now. It has offered unlimited liquidity to the markets. It's taken interest rates to zero. It's made asset purchases, even corporate bonds, that it's never made before. So you have all these positive things that the Federal Reserve is doing. So if you're fighting the Fed and fighting the tape, obviously you're either out of the market or short the market, and it's been a huge mistake because you're violating the most basic principles of equity investing. So if you want to be a better investor, don't think about the present, think about the future. Don't fight the Fed and don't fight the tape. So I talk about this subject and many more every week in my free e-letter, Liberty Through Wealth. And there I'll be talking about interest rates, currencies, commodities, stock markets here and abroad. And so I encourage you to sign up. Doesn't cost you a dime. Just follow the link below. And I look forward to sharing my thoughts with you every week. Thanks so much.